Hello, chart watchers, and welcome to this Wednesday, October 24th Market Watchers live show with your hosts, Tom Bowley and Erin Swinland. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. Well, the Dow Jones Industrial Average on another wild ride today after yesterday's roller coaster ride. The Dow Jones currently down 59 points, though we were down quite a bit more earlier. The S&P 500 down 16. The NASDAQ and the Russell 2000, though, both still underperforming on a relative basis. The NASDAQ down 76 points, the Russell 2000 down 12. The 10-year Treasury yield did rebound yesterday after being down quite a bit, but it's back down again today, down about 4 basis points, 3.13%, continuing to hold that support that we've talked about, down at about 3.10 to 3.11%. Volatility index on the rise earlier today, has been on the rise, as you can see from these rising lows over the past 6 trading sessions or so. So volatility does continue to be a problem, and that is why we continue to see these wild swings. XLU, utilities leading action to the upside along with real estate. Both of these groups are defensive and both are breaking out above recent highs. Also worth mentioning, not shown here, consumer staples having a strong day as well. Among individual stocks, Boeing had a great earnings report out. Stock did gap up. It's trading pretty close to where it opened. You can see from these tails that there has been some pretty wide range in terms of action on Boeing today, but currently it is about where it opened, up $10 from yesterday's close. To the downside, materials. This is a group that you simply just want to steer away from. It continues its free fall. It's been the worst performing sector of 2018, and it continues. Then you've got the XLC, which also is very weak today, threatening the lows that we saw a couple of weeks ago. And to the downside, from an individual stock perspective, AT&T reported earnings came up short of expectations, and you can see the market not very forgiving right now, down over 6% on AT&T. Erin, I tell you, the reports are coming in fast and furious for the latest quarter. I'm seeing a lot of good reports, but I'm not seeing a lot of great reactions.
Yeah, exactly. And as we've been saying, I think a lot of the great earnings news, is baked in. Everybody's been expecting good earnings and we're getting them, but the market is soft and we're still looking at a lot of bearish activity out there despite those great earnings.
Yeah, and I think, there's still an argument, I guess. Some might view this as, okay, we already had it baked in and therefore the news, it's buy on the rumor and now it's sell on the news. But I guess there's still the other side that's saying, well, maybe it's not just that. Maybe it is looking ahead, that maybe some of these companies are not going to earn what the market thinks they are, because the market does like to look ahead 6 to 9 months and kind of price things in. So, I guess there's an argument on both sides, but we'll talk about that in a little bit. I know we got a whole lot to go over, and we do have a special guest in here with us today. I know he's been here before, Roman Bogomazov. Good morning, Roman. How are you doing?
Hi, Tom. Hi, Erin. I'm doing well.
It's always a pleasure to have you in here, and especially with all these uncertain, swings back and forth. I'm positive you're going to clear all this up for us today, correct?
I'm not sure about that, but I'll give you my views on the markets for sure.
All right, that sounds good. Well, hang around. We're going to get back to you in about 15 minutes or so. And Erin, why don't you take it away and let everyone know what we're going to do today?
All right. Well, the upcoming week is looking pretty exciting. Dan Russo from Chaikin Analytics will be here tomorrow. Friday, we have Mary Ellen coming back for what's hot, what's not. And then you have your seasonality report coming up, Tom. And finally, I am so excited to announce that on Halloween, we have Dr. Alexander Elder joining the program. One of my, really, I look up to him and I've learned so much from his books. So looking forward to that. Today is going to be exciting, of course. Roman is going to be coming back and letting you know what he's thinking about the markets. Regions Financial, RF, will be our first symbol for the 10 and 10. And I will be taking your requests until 12:45 in the chat room. Finally, we'll finish up with Under the Radar. A couple of stocks that may be traveling under the radar that could turn out to be good. We'll check it out. Let's go ahead and start off, though, with some technical news and headlines.
Yeah, there was a bunch of news, both economic and earnings. So let's go ahead and take a look at some of this. We did have the August FHFA house price index out this morning. It showed a rise of 0.3%. That matched expectations. October PMI composite flash came in better than expected, 54.8 versus 54.1. But then there was another poor report out of housing. September new home sales, 553,000 units. Check out that expectation of 625,000 units. That's a big miss right there. So, you take a look at that, and it's not a shocker to see the 10-year Treasury yield lower. So let's take a quick look at that chart. You can see today that it is dropping. We've had a number of poor housing reports out of late, really over the past few months, several months, and that continued with the new home sales. That was kind of a shocking report to come up that far short. And of course, when the economy is seen maybe not as strong, then you get money flocking into the defensive treasuries. That is what's happening today. We got money rotating into the treasuries. As I mentioned at the top of the show, we're seeing money rotate into the defensive sectors. So what we're fearful of right now is continuing, and that is money that is seeking shelter. That's not what you want to see if you're bullish the market. Of course, the market was due for a pullback. So is it a correction? Is it a bear market? Well, we'll be talking about that a lot probably over the next several weeks. I believe that this is a correction, but we'll see. 10-year Treasury, though, that yield, we do want to watch that 3.10, 3.11% area. Okay, let's take a look at the earnings. Number of very key earnings, and the list is growing in terms of companies that will be reporting and that have reported. Texas Instruments last night after the bell came in better than expected, $1.58 versus $1.53. Alumina blew away the number on the top and bottom line. We'll look at that chart in just a minute. You might be surprised at the market's reaction to that one. Boeing, I mentioned earlier, nice earnings report there. Northrop Grumman came in way above expectations. Another interesting chart we'll check out. AT&T missed. Unfortunately, market not liking any misses right now. UPS flat versus expectations, and Norfolk Southern, a railroad, came in a little better than expected. So now let's take a look at some of these charts. And I'll tell you what, they are not particularly good, to be honest. I'm kind of surprised that we're not seeing better reactions to some of these. But let's start off with Texas Instruments. Texas Instruments did come in. They did come in better than expected on the bottom line, $1.58 versus $1.53. However, revenue came up short, $4.26 billion versus $4.30. You can see the gap down. This actually, today's gap lower took out lows over the past, really throughout 2018. This was the 2018 year-to-date low on Texas Instruments at the open. Is this an exhaustion drop, exhaustion gap to the downside? Might be a little early to tell, but at least currently, if we finish like this with a huge hollow candle and massive volume, this looks like we're going to have the highest volume day of 2018 with this earnings report. Off the downtrend, a hollow candle could put in a very significant bottom. We definitely want to watch and check this out. But we also are nowhere near the close yet. We still have another 3, almost 4 hours left in the trading day. So this candle could be anywhere. We know that from having a VIX in the 20s. Market does tend to go all over the place throughout the day. So let's see where we close today. But at least short term, we've got to be a little concerned breaking to a new 2018 year-to-date low. And you can see the semiconductors as a group are breaking down below these prior lows, also to 2018 lows. On a relative basis, Texas Instruments pretty much just sideways. So it's just been going along for the ride with the semiconductors to the downside. Unfortunately, it's underperforming the S&P because semiconductors are badly underperforming the S&P 500. So that's something that we want to watch. I think one of the more shocking reports out today, or at least one of the more shocking reactions to reports, is Alumina. This is a biotech. It's been one of the best stocks in the market going back the last couple of years. Beautiful move up here in 2018. Lots of good news built into it. We did see the technicals break down before this report came out, with the overall market dropping, of course. But you can see that the biotechs had not gone up to new highs, and yet during that same period, we had a huge move up in Alumina. So we had one of the better stocks within the biotech group report last night, and they beat on the top line, $853 million versus $825.7 million. The bottom line, $1.52 versus $1.26. Really big beats on both top and bottom lines. And what does that get you? It gets you about a 3% drop today in this market. the market that we've been looking at. So biotechs are under pressure. As you can see, they've been under pressure throughout October. Money is leaving riskier areas of the market. And again, that's not unusual when the market is selling off, but we need to see that change. Until it does, stocks like Alumina are going to struggle, even with good news. Another stock I wanted to bring up a chart on is Boeing. Boeing did make the gap up. It is struggling, though, to get back through its 20-day moving average. It may not make it. It was a great report. Easily beat bottom line. A huge beat on the top line, too. $25.15 billion versus $23.84 billion. They raised their fiscal year 18 revenue and EPS guidance. I mean, the report couldn't have been any better. We did get a nice reaction. We are up almost 4%, but we're nowhere near that earlier high. And again, as I mentioned, trying to get back through that 20-day moving average. How about another really big report on the bottom line? Northrop Grumman, 654 versus 436. I mean, you don't beat by much more than that. At least I don't see too many reports come out better than that. We got a gap up. We were up $6 or $7 on the open. And look at that huge red candle, just selling, consistent selling since the open. So even companies with great numbers, and Northrop Grumman, by the way, beat on the top line, beat by a mile on the bottom line, and they raised their fiscal year 18 earnings per share guidance. And look at what the stock's been doing. It just continues to sputter. You got to wonder, to me, it still comes down to the price action. The price action is not telling me anything good here to be looking for in the near term. AT&T missed 90 cents versus 95 cents. It had kind of started to try to change its direction. You know, looked like it was starting to change the character of its chart from a downtrend to an uptrend. Well, that got squashed with that earnings miss today. As you can see, these recent lows being taken out, trend line being taken out to the downside, very heavy volume. I think we got to be careful here. A couple other things I wanted to mention today. I did mention in my blog article about the German DAX. So I just wanted to point this out because when you look at the German DAX, this is a 10-year weekly chart. It's got a head and shoulder. It did confirm the breakdown just recently. And the correlation between the German DAX and the S&P 500 is as strong as any foreign market with the S&P 500. So when you're starting to see some bearish breakdowns on the German DAX, and you can see that for the most part over the last 10 years, we have positive correlation, that should keep you a little worried about the S&P 500 because we went into negative, had an inverse correlation there for a period of time. And the reason was the S&P kept going higher while foreign markets, including the German DAX, were going lower. That's why we got into that negative. Now we're starting to move back into positive correlation, and we're seeing both of the indices moving lower. So as this continues moving higher, one of two things has to happen. Either the German DAX has to get back up through that neckline to support an S&P 500 move higher, or the S&P is going to continue to follow the DAX to the downside. I know which one I want, but we got to see which one happens. But I just wanted to point out this is a pretty significant technical development on the DAX. This measurement would be of roughly about 1,700 points, which would take the DAX down to about 10,000. Currently, well, as of the close yesterday, the DAX was at 11,274. So still another 10% or so possible to the downside. All right, a couple of charts that I wanted to show you. Let's take a look at first an intraday chart. This is the S&P 500 over the last month moving lower. And here's the XLRE relative to the S&P. These are the defensive sectors relative to the S&P. See how they continue to rise? That needs to change. If we take a look at the S&P 500 from a long-term perspective, we're still in a nice uptrend. And the outperformance of defensive stocks is occurring during this pullback, which is typical during pullbacks. I just want to show you, though, back in the first quarter of 2018, the S&P really doesn't start moving back up until we break these uptrends on the defensive sectors. We saw it on the selling back in late January, early February. We saw it in the second half of March. When this selling takes place in the S&P, money rotates to defense. We need to see these relative uptrends break before, I would expect too much more to the upside. And then the last thing, let's go back to the current picture. Here's where we are in the month, but this is the last 3 months. And you see the S&P going higher. you see on a relative basis, these defensive areas moving lower. But right now, these defensive areas continue to push higher as the market sells off. I think we're going to have problems sustaining any kind of move to the upside until the relative strength in the defensive areas breaks down. And who knows when that happens. So just be careful out there. I know we got a handful of upgrades, downgrades. Erin, what do you got for today?
All right. And I've got an interesting one to start the list off. Avery Dennison, maybe if you watched the show yesterday, you probably remember this one as one of the spotlight stocks. And if you recall, Tom and I both did not like this one at all. I don't know. Tom and I talked about this one before this morning, and we still don't like it. But it was upgraded today by JP Morgan from a neutral to an overweight. I looked at this chart again. We're getting the breakdown even on the upgrade. If you go to the weekly chart, it's even uglier. I mean, you're not looking at support until we get back here to the $75 range. So I certainly wouldn't be looking for this one to have a reversal despite the upgrade. So I would leave that one off your list. I don't think you need that for a watch list unless you're thinking about shorting. All right, 3D Systems, Piper Jaffray upgraded this from an underweight to a neutral. I think this one looks pretty good, actually. We've got a falling wedge, which is a bullish pattern, and it looks like we're trying very hard to break out of that. We had the breakout here, but it didn't sustain it. It came back down. So we'll have to see if we can sustain this breakout. But if we do get it, just doing the measurements, it tells me that we should get back up to this high that we had back in August. And notice the PMO. It is in negative territory now, but it is trying to turn up right now. So this one, 3D Systems, I think looks interesting. Another upgrade today, Lululemon. This one was upgraded from a hold to a buy. And let me get this chart to crunch in here. All righty, there we go. All right, another upgrade that I wasn't thrilled with. You have a PMO that's now in negative territory for the first time this year. You have a 20-50-day EMA negative crossover in the process of coming together, and that would give us, as far as decision point is concerned, a intermediate term trend model neutral signal. You have this gap right here. It was filled. It does look like we're trying to come back up to back up close to that top we had here earlier in October. But, despite a nice scooter, I'm not really thrilled with this one. Mainly the PMO has got me a bit nervous about that upgrade. BJ's Restaurants, this one was downgraded. We're going to look at some downgrades. BJ's Restaurants, BJRI. This one on the downgrade, I think was a good idea on a downgrade. What I'm seeing here is, of course, a breakdown at about this area of support at $65. And we are trading, we opened below it and we're trading below it, which we haven't seen since back here, since we did the breakout in August. So PMO has topped below the signal line. It is heading further south. And another one where the PMO's in negative territory for the first time this year. And finally, Yum Brands was also downgraded today from a buy to a hold. I think you have loosely could say we have a double top here. It's a little messy here on this side, but I still think you could make that case. Doing the measurements, we should expect a downside move at least to the $82 range. But when I look and try and find some support, maybe near that, the best I could do was down here at about $80, where we get some lining up of that low, a few tops here, a low and a top. The more touches, the more likely it's a good line that you've drawn. So anyway, I would expect this one to fall at least 82, could fall down to 80. So Yum Brands looks like a pretty good shorting opportunity. And just a few others, big name upgrades, AutoNation, Devon Energy, Etsy was upgraded, Morgan Stanley. PCAR, interestingly, was upgraded today and downgraded today. Kind of an interesting one there. LG was downgraded, Sally Beauty was downgraded, and Republic Services was also downgraded today. All right, that completes those upgrades and downgrades. Let's go ahead and bring back Roman. I'm sure you're out there waiting patiently.
I'm here.
Yes, time to give us your outlook on the markets, and be sure and take the poll. Roman came up with a poll, and I'm sure he'd like to see some of the results. So go ahead and go take that, and I'll hand it to you.
All right, sounds good. Can you see my screen?
You're good.
Okay, excellent. Thank you, Erin. Thank you, Tom, and hello, everybody. It was interesting to hear Tom and Erin go through some of the stocks, and we see on good earnings, there is a bad reaction to that. And to me, there is always a question, who sells into that strength? Who sells into that positive, favorable earnings reports? And obviously, my answer to that is going to be it's institutional selling. And if it's institutional selling, what does it mean? So we're going to go through today's presentation, and we'll try to identify what institutions are doing, and relative to everything else in the world, how the US is doing as the economy and, in terms of the structure. But before that, I want to start with some thank yous. You see here a Power Charting logo. And on behalf of Bruce Fraser and myself, I'd like to thank everybody who watches Power Charting. It's on StockCharts TV. It comes out on Fridays at 12 Pacific. So thank you for watching that program. The last session was on the market price cycle. We discussed how institutions are accumulating, marking up, distributing, and marking down stocks. And we gave you a couple of examples right there. On Wednesdays, Bruce and I conduct a Wyckoff market discussion. It's going to start today at 3 p.m. So this is just a very detailed look into the markets, into U.S. markets, international markets, sectors, industry groups, stocks, commodities. We look at different stuff during different sessions. So if you want to check this out, come to wyckofanalytics.com, sign up for that. There is quite a lot of free stuff that we have, Bruce's blog on StockCharts.com, and you could also check out our educational offerings on YouTube on Wyckoff Trading Method channel. And if you're interested in Wyckoff education or just technical analysis education, come to our website, wyckofanalytics.com. Check out our offerings. Contact us at wyckofassociates@gmail.com. My last announcement is about November special. I will be conducting this special starting on November 1st. The topic, the conversation, the discussion that we're going to have with students is going to be about the usage of conventional technical analysis tools in combination with Wyckoff method interpretation. So that's going to be an interesting one. Okay, well, with that, let's go to our first case study. And our first case study is going to be about the market. So everything today is going to be about the market. I was thinking about what I should bring to the table, whether I should, put some theoretical material, but then the market is extremely interesting. And I'm sure that there are so many questions about this. So I'm just going to give you my view. And this view is actually based on the Wyckoff market discussion. I took actually quite a lot of material from our last week and kind of developed a little bit more of that material. So the first thing that we're going to look at is the health of the US markets. And we're going to use NYSE percent of stocks above 200 moving average. And the conventional wisdom is that once we drop below 50, below 40, below 30, those are the places that are going to create significant cyclical and secular lows. Those are going to be, secular lows are going to be the lows after the bear markets like 2009, 2003. And then cyclical lows are going to be in line within the context of an uptrend, for instance, 2011, 2015, 16. So we are starting here with the lows because we want to establish some kind of baseline for us. Usually at those big secular cyclical lows. This is where the accumulation by strong hands starts to happen. And what happens after that? So let's say that we've hit those lows and they accumulated the shares. The next move, and we see this from the breadth of the market, we see this from the NYSE percent of stocks, is going to be the most expensive, the largest momentum move that we're going to see. Why is that? Well, it's actually very simple to think about, because if you think about all of the downtrends that we have had, even cyclical downtrends, what does it do to the stocks in general? It depresses stocks, right? So we see lower prices, and we see lower prices throughout the whole universe of stocks. So when big interests are accumulating at the lows, it absorbs the supply of available stocks. And after that, as the stocks are making new highs, there are quite a few of the stocks that are going to be making the new highs. So the percent of stocks above 200 moving averages is going to increase. It's going to increase dramatically, and that's going to be the biggest momentum move on the breadth indicator. The next step in our uptrend is going to be just a trending environment. And usually during the trending environments, we're not expecting a lot of stocks to be above 200 moving average. It's actually going to be a lower number usually than the one that we had on the first initial momentum move. And that's very logical, because there is a selection process that's happening throughout the uptrend where the leadership is being overly focused on, concentrated on, and then the laggards are kind of like staying behind. So you're going to see the drop in the percent of the stocks during the uptrend. And that's actually a very healthy environment for uptrends. The next step is going to be, and this is a little bit hard to catch, not visually, but just in terms of the finish line. We're going to start seeing some divergences at the market tops, or going into the market tops. We're going to see that the number of stocks above 200 moving averages is going to contract. At the same time, the trend is still going to be up. And this is that environment where all of the analysts are going to be saying, like, well, we're seeing this divergence, so there is something coming. There is something coming, and you're going to hear this for years and years, months and months, in the secular cyclical uptrend, and nothing's going to happen. Well, something is going to happen as the next stage comes, and that stage is very interesting. This is something where our Wyckoff interpretation comes for help. We are going to see some kind of breakdown into the new lows on the breadth. And we also, in the price structure, finally going to see some kind of more meaningful hesitation, or what we're going to say in Wyckoff method, a change of character. And that change of character is going to identify the first distributional characteristics. And those distributional characteristics could lead to a more significant downtrend, or they could lead to a cyclical downtrend, or they could lead just to a rotational reaccumulation pattern. And we just want to identify. And to me, in the current markets, that's the question. Are we in the distributional pattern, or are we in the rotational pattern that has distributional qualities to it? All right, so what happens next? Well, the next thing is that big move to the downside. It's going to be visualized both on the percent of stocks above 200 moving average. They're going to go below 30%, and we're also going to see the prices going down. And again, depending on where we are in the structure, are we in the let's say cyclical downtrend? The structure will be different. Or are we in the cyclical swing to the downside? Or are we more in the rotational pattern? So the next question that I want to ask is, let's look at the current structure, and let's think about why the structure happens or unfolds the way that it unfolds right now. So, and this is the case study where I want to look at the international markets. But before that, I want to give you a very quick synopsis of what I think why we are exhibiting a lot of volatility right now, and why the US market looks structurally different than everything else that we see in the world. And this is something that I usually do not discuss a lot, but here are some of the bullet points on macroeconomic ideas behind the trade talks. It's my belief that everything that's happening right now in the markets is related to trade talks. And the reason why I think so is because I'm looking at the world wealth around the world as kind of like this big pie. Imagine that all of this are just the countries with their economies that are contributing to the world economy. And basically, the trade talks are suggesting an idea of the redistribution of wealth. So think about that idea, redistribution of wealth. What does it mean? What does it mean for the US? What does it mean for other countries? It means that some of the investors are going to see this as a negative thing to the assets that they have outside of the US. And they might be inclined to sell those. And their money is going to be going into the assets where they will see more future potential. And therefore, US is one of those assets that's going to benefit from that. So what does it lead to? Let's say that, and I don't know exactly what the effect of those, tariffs is going to be. I think we need some time to comprehend, and to see the data as to, is US even benefiting from this or not? How's the world benefiting or not? And so on and so forth. But we're seeing that this redistribution of wealth, or at least an idea that, this is how it should be, that comes from the US administration, it leads us to a slowdown in non-US economies. That influences the revenue of the US multinational companies. And that is happening still on the background of a very strong US economy, which acts as a flight to quality asset to world investors. So think about the structure, right? So the money comes to the US. What kind of, technical analysis structure for the US markets we have? Probably more favorable than, other international markets. And that happens on the background of rising interest rates. And that's the biggest question, that brings up, the increases in the business cost. And there is a lot of talk about that, which creates an expectation for future major slowdown, even for the US economy. And Fed cannot do anything about this, but keep raising rates to neutral to have more room in the future to ease again once the slowdown, is going to come to the US in a major way. And but we still have a lot of liquidity, which is really good for participation in the US markets. So that's kind of like the macro logic that I see, macroeconomic logic that I see behind this whole trade talks, which leads us to the macro technical analysis picture, where we see a lot of distributional patterns in non-US economies, and we see high volatility in the US markets and distributional, depending on the industry groups, or rotational patterns in the US markets as well. So the question here, could we see this logic on the charts? And to see this logic on the charts, let's look at some international markets and the US markets. So here's the first chart. The first chart here in the left top portion of the slide is the US S&P, and it's a leadership. We're seeing that the last rally has produced a higher high. Do we see this from other international markets? Well, let's look. Let's look at Australia first. We're seeing that the same rally produces a lower high, and then we already see in a lower low. That's a conventional definition of a downtrend. And obviously from Wyckoff perspective, we're seeing a climactic run, change of character, secondary test, attempt to go up, failure around the area of the resistance that was created before the character of the move to the downside changes on the volume signature that is expanding. So we see the effort to the downside increasing and the result to the downside increasing. There is a synchronicity to the downside, a downtrend. The same happens in China. And China is very interesting because obviously, this is a major participant right now in trade talks, and we see a quick climactic run, change of character, a trading range where highs are failing to reach the previous highs and to retest the buying climax. A failure is a sign of weakness, and then another trading range, another possible redistribution, and the price is just really, really hard, to come back to the trading range. The last 2 days or 3 days has some positive intent there, and some volume signature has come there. And I think it's very important for us with the Chinese market specifically just to look at that and to see if we're going to have some kind of continuation. Would we come back into the trading range? And obviously that's all related to the potential stimuli that Chinese government is discussing. Look at Canada. Again, the picture is the same. A big change of character, attempt to go up, lower high, and then a lower low. So again, a downtrend. Next 3 charts, France, same picture, lower high, lower low. Germany, lower highs throughout, lower lows, and this is the strongest economy, or the largest economy rather, in the European Union. Look at the United Kingdom, the same pattern, change of character, attempt to go up, failures everywhere, and lower lows. Again, conventional technical analysis definition of a downtrend. Next 3 charts from Asia, Hong Kong. Again, attempt to go up, and look at the rallies here. They are so weak, and there is no capacity to lift here. Lower lows, lower highs, a downtrend. Japan, same picture, multiple attempts to go up, multiple failures. The last attempt has an excitement about that rise from weekends, and yet somebody is selling into this rally, and then someone is selling on the way down. And we don't like when there is a selling on the way down, because usually that type of selling with this type of volume signature is going to show institutional selling and selling into the excitement of weak hands. So this is not a really good selling for us. Taiwan, the same picture. Again, multiple attempts to go up, lower highs, lower lows, a downtrend. So on this background, the US is a leadership, and it's really, really hard to see any distributional patterns or distributional rotation on the leadership charts. So let's look at some structural scenarios. So I like to discuss with students potential scenarios as to what could potentially happen. And the biggest question here is, what does the current structure represent? Is it a distribution or just a rotation? Well, let's look at first scenario. In the first scenario, we're going to say that, well, what is this? What if this is a rotational reaccumulation? Could we potentially go higher from here? Could we have maybe a higher high from here and overcome the previous high or the previous 2 highs that we have had? Well, let's look at the daily chart. First of all, we see that the character of the down move has changed drastically. Right, so all of the previous reactions that we have seen before are of a different quality than the one that we have had as a change of character in October. We would want to see in the reaccumulation an ability of the price to come back to the higher levels of the prices that we've seen before, and we don't see that lift, at least yet. So for the bullish scenario, what needs to happen is something what we've experienced before in April and May. It's an absorption of the supply that comes to the market that needs to happen. And usually absorption will have elements of diminishing spread signature, diminishing supply signature. And so far, we don't see that. Instead, we kind of, cannot come back, to the higher levels. That's number one. We're still making intraday lower lows. And then every attempt to go up and to lift the price up ends up in actually price fallen down, and it's fallen down again on the expanding supply signature. So selling is still persistent there. So we need for the bullish scenario, and I'm looking here at the 15 minutes, is to overcome this bearishness and have the capacity to lift the prices up. On the intraday basis, and this is, like from 45 minutes ago, we had a big bar like this, and now this looks, this bar looks very bullish, right? But please notice, guys, what has happened before. We had a failure to reach a resistance on the intraday basis, the resistance that was created by the change of character on October 11th, the 12th of October at the beginning of the trading range. And that's a significant failure because the intent behind this action right here, where we are committing temporarily below the support and then coming back into the trading range, would always be not just to reach the resistance, but to overcome it in some kind of sign of strength rally, and then gradually come down to the levels of the support that acted before as the resistance into the backup action, and then continue its move to the upside after this, resume the uptrend. Do we see that? No, we are failing at this top. We are coming to the support level. This bullish bar was a really good bar, but I'm looking at the prices right now, and they actually come back to around this area right here. So in the downswings, in the bear markets, we're always going to have the aggression of weak hands to push the price up, and the aggression of short sellers to cover up and to push the market up. And then we need to see at the test of that action. And we're looking at the test. Our first test is failing, prices are going down, and then there is a second action, with this big bar, and then again we are failing. So for the bullish scenario to unfold, we need to kind of consolidate here, consolidate around the idea of the absorption of the supply, and then we need to break the trend line, and then we need to break the resistance. We have to have the capacity to be above certain levels of the resistance, and that would give us an indication that maybe on the daily chart we could consolidate and then try to go up. And if we do go up after the absorption, we probably would make a new high, and that would be so exciting for weak hands, to be at that spot, to buy at that spot, and that could become another selling point for institutions, if indeed there is some kind of distributional pattern. All right, well, let's look at the ideas here. Well, how would you trade this scenario, a bullish scenario? I'm very cautious on the upside. Actually, a lot of my bullish positions were closed out last week, and I had to get out of those just by the rules that I have. So what kind of advice could I give here? What kind of charts would we be looking for? Well, we want to look at the groups that are that have some kind of favorable bullish pattern. So look at the telecommunications. There is an attempt to go down, and it creates a higher low. So there is a diminishing result to the downside, and that happens on the increased supply signature, on the increased effort signature to the downside. So we're trying to push the price down, and yet there is no result to the downside. That's favorable, that's bullish, at least short term. So, and with all of the market volatility, look at the reaction by this group. It's actually trying to go up, trying to lift up the prices. So this is something that we would be looking for as a pattern. And then obviously in the group, we want to identify the stocks that are favorable in terms of the technical analysis pattern. We are looking for the stocks that are in the established uptrend, in some kind of consolidation, maybe with some catalyst on earnings, which we've seen in Verizon, maybe in some catalyst like McDonald's that we've seen also rising before the earnings, and favorable overall structural pattern, again, with the same elements of the increased effort and the decreasing result to the downside on the background of such a bad market volatility. And the same for the group here, restaurants and bars. We are in the uptrend here, in the upswing, and we're close to the resistance that was created by the buy-in climax. So those are the ideas that I would be thinking in if I'm thinking about the bullish behavior. The only problem here is that there are not a lot of these patterns right now, which tells us the story about where we are. And also, once you are in this pattern, you just have to think about your intention for the trade. Is it a short-term trade, or is this a very long-term oriented trade? And also structural position. If the stock is breaking out, is this the time to buy right now in this climate or not? Let's discuss a distributional example or distributional scenario. And here we have S&P and composite. And there are two ways of how leadership could be distributed. And that's why it's so difficult to see a distribution in a leadership stock or in the leadership market, because the leadership is going to be distributed on the way up. And usually leadership is going to have characteristics in the structure where we're going to still observe higher highs and higher lows throughout the distributional structure. And that's what's so tricky about the current situation. And that's why I'm asking this question. Is this a distribution, or is this a rotational reaccumulation? In both of the patterns, we're going to see elements of the volatility coming into the market. And a couple of schematics that I've developed, for the leadership distribution. And one of them is a distribution that happens on the change of character and then has a texture of a reaccumulation. We have all of the characteristics that leads us to believe that there is an absorption in this area, which dictates the price to go up at some point. And then as the price goes up and breaks out above the high of the buy-in climax, we are going into the upward situation where weak hands are becoming more excited and they're getting into the position. And based on that excitement by weak hands, big interests are coming in and selling off the top. They want to sell off the top. And, we could definitely see all of those characteristics. Another pattern, here are the same characteristics where we're seeing higher highs, higher lows. And it's only at this point when on the breakout to the downside where this is where it's going to become more evident that this is a distribution. So we should be noting all of the levels of the support. If they're going to be broken, most likely our next targets are going to be at the lows of the sell-in climax previously in February. And that would confirm a more significant distributional pattern. Well, let's look at some analogs for the distribution. And we definitely want to see the analogs that have some kind of strength structure built into it. So let's look at the S&P as a 2000 top, and we kind of see the same structure, climactic run, change of character, then elements of the absorption that happens at the level of the support, and then ability of the price to go to the levels of the buy-in climax that we've seen before. In this case, in 2018, we're seeing an upthrust. In the case of 2000, we had just an attempt to upthrust and then a failure. S&P 2007 top, kind of the same picture. We have that climactic run, change of character, absorption of the supply that has come on the change of character, attempt to go up, upthrust, and then a complete failure back into the trading range. One of my favorite analogs for current picture is actually the leadership stocks that we have had in the 90s. I was trading that market, so I remember it really well. And look at the Oracle, look at the Sun microsystem, look at Microsoft, look at Dell. Those were the leaders for that particular market. So we want to understand how those leadership stocks were distributed in this market. We want to study that. And we kind of see in the same pattern where there is a climactic run, a change of character, attempt to absorb the supply, and then attempt to overcome the previous resistance in the upthrust manner, but then there is a failure. So if we look at those analogs, the biggest question to me is where we are in those analogs. And it seems to me that we're somewhere here if we're thinking about the distributional scenario, then we could be here. If we are failing, this support right here, most likely is going to bring us again, to the lows right here. And we will have some kind of bounce off this lows, because that's what this model is basically showing. And the reason why we're going to have a bounce off is because there is some value for institutions at this point. So they want to come in and to buy. And those are going to be institutions that are weak hands. They are not necessarily going to be strong hands. And the last slide that I have for you guys for this scenario, for bearish scenario, what kind of ideas could we have? At this point of time in the structure, if you truly believe that this is a distributional structure, then there is no reason to shy away from shorting the stocks that were leadership stocks before. And we're seeing this from the semiconducting stocks. SMH has been such a big leadership, an engine for this whole run to the upside. And then there is no more capacity to advance the prices. And we kind of seeing that obviously after the fact. And I would say that to me, to be realistic, is where would you be shorting? Well, I personally, a trader who always seeks a confirmation of a specific idea. So once the group starts to go down and we see the increase of institutional selling, at this point of time, again, after the change of character, after the upthrust, after the next change of character that we had after the upthrust, the leadership stocks could be distributed as well. So we're seeing here how the character is changing for Novadia, the former leadership. And actually, full disclosure, I shorted Novadia and I'm still in this position. So, and semiconducting stocks are still looking weak to me. Now, having said this, you have to think tactically, because shorting is a tactical trading. You have to think that you can't really short at this point. You probably want to wait and see some kind of test of the previous highs, ability of the price to come back to the level of the resistance that acted before is the support, but inability to come back into the trading range, some kind of weak rally, and then a failure again. So another opportunity probably is going to present itself a little bit later on. Tom, Erin, this is all I have for you guys today.
Wow. That's a lot to absorb. That was a great presentation, Roman. I mean, it was.
Thank you, Tom.
Yeah, you really hit on a lot of topics. I know there were a couple questions in the room. I think you already answered them before we even had a chance to ask them. So I thought it was a great presentation. Was there anything else, Erin? Any other questions?
Somebody was talking about the flight of capital to safety, into the bond area. What you thought about that, because we really hadn't discussed that.
Yeah, it's an interesting picture there, right? Because we would be thinking that, there would be that flight to quality. But we've seen some of the patterns where bonds are not behaving, exactly the way how we would be expecting. And obviously, the interest rate is influencing that, and it's a slightly different model that I'm seeing that is unfolding right now. And that's why, listening to you guys yesterday and preparing, for my presentation today, I kind of agree with Tom, and I think, Erin, you also said this, that it's still a question, are we in the distributional pattern, or are we in the rotational pattern based on those trade talks? And the volatility that we see in the US markets is just that. So the strength of the economy suggests that we might have another attempt in the US markets to absorb the supply of what we have right now and try to go up. But my trading right now is all tactical. I'm not really thinking a lot about what the market should be doing. I'm thinking more about what it is doing, what is showing to me right now, and I want to be in line with that. And all of my trading right now is a little bit more short-term oriented rather than longer-term oriented like it was in 2017, and even the first part of 2018 after the absorption.
Excellent.
Question for you, Roman.
Mm-hmm.
You mentioned that just recently you had long positions and you got out of them because you were following your rules. Was there any particular rule that you can share with us that got you out of those positions?
Sure. Let me show you a chart. I've been in this position, Shake Shack.
Okay.
So I actually had a couple of successful trades in Shake Shack. And my first points of entry were right here and here. That was based on a long-term trading range. And actually, I'm just thinking about the time. Do we have more time or not? So I'm trying to go fast here.
Fine, take your time. I do want to say, though, we had Bruce Fraser on the show several months
ago. Yes. Bruce was discussing the stock.
Yes, he went over this when he said he owned it. And I think it was before the earnings pop to the upside. I guess you all probably are sharing your notes, I'm guessing.
Yeah, we were discussing the stock in WMD, and I think both of us got out. If not at the same time, then it's slightly different time. My points of entry were right here and here. And then this was the earnings report. So I'm a swing trader mostly, and I use a lot of the directional options trading. This is, creates the leverage for me that I crave, and, it just produces the P&L that I want. So my exit was just on the catalyst. I was seeing a lot of supply coming in, and obviously this was a slightly premature exit, but it was a profitable trade. Then the next trade that I had was open right here. So there is a diminishing supply signature going in, into phase C, and for the first, couple of weeks, everything was okay. But then look at the break. Look at the break to the downside on the increasing supply signature. Look at the inability of the price to go up after that and create the new higher high, and then the failure after that. So my exit was partially here and partially here, and I've closed out the position completely at around 58. So when I talk to students about my trades, I always say that my trades are not perfect, and I have not met a single person yet who would have had at least a big number of trades that are repeated winners. I think that the biggest number that I had when I was trading intraday was 22 trades in a row when I was successful, but that's about it, and that's very unusual. I've never was able to repeat anything like this. I think what's important here, and the lesson here, is that you could look at the accumulation that we're seeing here in Shake Shack. You could see at all of the signs that point to us that there's going to be an uptrend. And then once there is a failure like this, you got to get out. No matter what you think, no matter how you feel, the rules are rules. They're there for us to follow. And that's why I got out. And this was a slightly unprofitable trade, but I'm really happy with the exit.
Yeah, and the other thing that I would mention too here, Ramon, it sounds like the, your trading strategy definitely takes risk management into account.
Absolutely.
I know earlier you said that, if you're thinking about shorting, this might not be the best time because we have come back quite a bit. Mm-hmm. So if you were going to take the short side, would you then be looking for a move back up, you said, to recent highs? Would you short the indices, or would you, like the spider, I guess, whatever the inverse is, or would you be looking at individual stocks when you?
So I've been doing research on the distribution of the leadership stocks and the way how they are being distributed. There are certain, it's a timing tool. It's a timing question, Tom. So on the first leg down, there is a lot of selling of laggards or lagging stocks. And then on the second move to the downside, this is where the leadership stocks are being distributed. And that's why the US, the structure for the US market is so obscure to us, because it still shows that we are in the uprising structure. And at this point of time, at this second stage, let's say if we are in the true distribution, at the second stage, you can go for both. You can go for the stocks and you can go for the ETFs. I was looking at the comparisons between shorting the ETFs and shorting the stocks. Actually, ETFs sometimes has an advantage because that second stage could produce such an immense capitulation by institutional hands that's going to increase the velocity to the downside, the momentum to the downside. Having said this, another area of where we could benefit more on the downside if we're shorting are going to be the leadership stocks that are going to be distributed by institutions. So, and that's why, my recent positions were in semiconducting stocks, and they are acting really well to the downside.
I agree. All right. Well, it has been a real pleasure having you on here. I think everyone enjoyed your presentation. Very easy to follow along and very interesting as well. So always a pleasure.
Thank you so much.
And we look forward to having you back soon.
Thank you, Tom. Thank you, Erin. Thank you, everybody.
You're very welcome.
Wow, that was so good. Very enlightening.
Absolutely. Yeah, it's you can tell people who have been teaching also for a living. I know he was a student, but I think he's actually a professor now. So yeah, it's nice. It's easier to follow along. I know Bruce is very similar.
Yeah. All right. I know when he brought up Shake Shack, I know we had Bruce on, and Bruce was talking. I specifically asked him to give us a stock that he liked, and that was back before that earnings report on Shake Shack when it took off. So,
yeah,
that was an in the moment kind of a call that turned out to be a very good one.
Absolutely. All right. Well, let's get started on that 10 and 10. We're getting started just a little bit late, so I'm not going to worry about the RRG, but I did want to just say that the majority of requests were from the consumer, discretionary, and technology sectors. So I thought that was pretty interesting.
Yeah, I probably wouldn't be looking there unless I was looking for shorts right now, because those groups have been underperforming the S&P on the way down. A lot of distribution taking place there. Of course, again, as we talked about, and as Rahman just talked about, it's hard to tell at this point whether it's, correction or bear market kind of action. The next few weeks will probably tell us a lot about that. But anyhow, let's go ahead and get started. I'm going to try and do this 10 in 7 minutes. Try and set a record here. Regions Financial. First of all, you had a very significant breakdown back in July, taking out these multiple lows. That was a little bit of a false breakdown. We went all the way back up to test the overhead resistance, and look at what has happened since. I think probably getting back to some of the Wyckoff talk that we just had. I think you can definitely see with the volume picking up, this is some serious distribution taking place. And even yesterday's, big hollow candle on big volume, I would have expected at least a short-term rally, and we haven't even gotten that. So I think there's a lot of folks bailing out of RF. I would not be in it. I would be watching from the sidelines.
All right. Let's see. We have the most popular in the chat room is actually, it's Walmart, WMT.
All right, Walmart has actually been a really nice performer, and I think this is one of those stocks that's going to get a pass with the overall market. I know that their earnings report that came out back a couple months ago was very strong. We had that nice gap up, and I see an uptrend with a cup. So I would expect that maybe we will get a little bit of consolidation after the cup forms. I do think we're going to go up and hit this 100 level here in the near term. But I think when you look at this, this is a beautiful cup off of an uptrend. I maybe would look for a little consolidation between 96 to 100, but I expect this is going to break out and move higher.
All right. The other big request in the room that I thought I would include is AT&T. T.
Yeah, T we looked at a little bit earlier on the earnings, and it's just not good. I mean, it broke down the uptrend, could not clear the overhead resistance. Actually, it was more about this gap resistance. See the massive volume back at the end of April. That was earnings related. We have not been able to get back through that level. And it looks to me like we have broken back down below this support or trend line support area right in here. So I don't like the action. You do still have price support from back at that July low, which also was related to earnings, I believe. But I think we're going to head back probably to that 29.75 area. I don't like AT&T here.
All right. Well, let me know if you're sweet on this sugar fund. Cane is the symbol, CANE.
Yeah, I mean, this looks pretty good. Light volume. So this sugar fund, isn't something I probably would trade. but it's hard to argue off the bottom here. We got nice positive divergence. So let me just annotate that. Anytime you see, actually, a textbook definition of positive divergence, I don't know that I necessarily would follow it because we did have this move up in between. But actually, let me just change this because I think what we did have was move back here, which was clearly a positive divergence with only 20-day tests in between. So I think we actually had a positive divergence. We had a move, went back, put a double bottom in, and now have broken out. So here's your double bottom right down around 650. Here was your breakout level, I think pretty clearly. Lines up with a major low back in April, a pretty significant short-term top in September, and we've broken out. So I think to the downside, and I think this gets back a little bit to Roman's point, that, you know, when you get, I don't think it really matters whether you're going long or short. I think when you've got a market like this that, or a stock or a fund like this that has made such a big move, I would be looking for some pullbacks. And I think these are the two key areas, that rising 20-day and then price support near 725, 730.
All right. The next one I have is for our Canadian friends. It is PEY.TO, exploration, PETO exploration and development.
Yeah, we had a breakout, but the volume wasn't there to confirm it. That always makes me a little bit nervous. I mean, we went down, we were sideways consolidating. Here was a reaction high off of like a double, triple bottom here, February, March. Here was the reaction. We went all the way back down, didn't quite get back down to the support level, but we did, actually, we almost did get down to the support level, but a lot of sideways, and then it looked like we were breaking out. But look at the volume down here. There's really no volume to speak of. And now we're coming back down. We really, I think, need to hold this 20-day moving average and break out with volume. If we don't, I think we could head back down toward the lows. I would probably be very cautious with this one and look for a move higher from here, or I'd be getting out.
All right. Next one is Tupperware, TUP.
Oops. All right, Tupperware. Well, this could turn out to be a breakaway gap. I don't know if I didn't see earnings, but I'm guessing this one must have had earnings today. And I think it's pretty clear that we have a downtrend in play. You connect all those highs, and this is going to be a very significant volume day. Right here, you can see the volume already picking up. And that right there is very significant because it looks to me like you are changing the character of this chart. And with the PPO up here, breaking back above zero, I think this is a nice looking chart. Now, I don't think I would chase it today, but this is one that would certainly go on a watch list. And I think if you get anywhere back down near that 35, 36 area, this one could be very interesting on the long side.
All right. Have to agree with you there. How about Kellogg, K?
All right. Well, we're talking consumer staples, so that's always a good thing in this market right now anyway. Let's take a look at what the chart is saying. Yeah, I think we held on to some pretty key support. We had that big drop back at the beginning of August. And so you can see that intraday low. And from a candle body support, that's highs, or excuse me, closes and opens. You can see the 66 to 68 area is pretty important. We held that on the last low, pushed back up above the 20. I've talked about this a lot recently. When a stock breaks down below the 20, you want to be careful until you can get a move back up above. I think this is a perfect example. I look for Kellogg's to make a run for 75.
Okay. Let's look at Hologic, HOLX.
Okay, a lot of, I'm going to stretch this out maybe a couple of years. I don't know if this is a long-term symmetrical triangle. Wow, this thing is really going back. I'm going to go back even a couple more years. So we won't be able to look at the daily data very closely. Yeah, we had an uptrend. Let me just annotate a couple of the key levels because I think support is very clear here going back. I think it's pretty clear that this area right around 36 or just below is major support. I think also we keep getting lower highs. So that's a little concerning when you look across here and you see that we keep, each time we bounce a little lower. Seems like it's going to head back toward that 36 area. So I wouldn't be doing anything with it at this point. I think it's too risky.
Okay. Next one is O Realty.
Right. Oh, Realty. Well, it is trying to make a nice breakout. I'm going to pull this one up on the relative chart. Yeah, this breakout is nice, and it's actually occurring when its industry group is going lower. So this is a really solid relative strength trade. The stock is definitely one of the best among its peers. It's trading up versus the S&P. Its peers are okay versus the S&P, but this stock's individual strength is such that it's providing some serious outperformance, and it's just breaking out. I mean, this I could probably have used on my under the radar. Beautiful uptrend, sideways consolidation now today, making a pretty big breakout. I like it. I think the stock looks good. I'd probably be in it as long as that rising 20-day moving average continued to hold.
All right, and the last one, Western Digital, WDC. Interesting support level right now.
Yeah, I don't like that descending flag, though. I mean, this is in a group that has been performing really well, and Western Digital has not. So you can see the relative performance is just abysmal. The volume looks pretty heavy on the way down. I just see a lot of distribution. You do have the support area in the near term, but I would be concerned with a possible, I don't know if earnings or something, I would be concerned with possibly a gap down because you do, off of this downtrend, have what appears to me to be a descending triangle, which is very bearish off of a downtrend. I think the stock goes lower. I would not be a buyer on this support. And again, if I was looking in this space, I'd probably be looking for another stock within the space. It's just been a horrible performer. I'd let it go.
All right. And that does conclude the 10 and 10. Very good, Tom. We did it pretty quickly. Yeah. All right. It is time for the...
It wasn't in 7 minutes, but maybe I got it in 9 or 10.
We got this. All right. Let's go ahead and do our final market update real quick so we can get into some under the radar. All right, what has been going on? Well, clearly the decline is still in play. It looks like we tried to get back up to positive territory on the Dow, but did fail. Currently, the Dow is down about 0.85%, but and you can see the S&P 500 continuing this declining trend. NASDAQ definitely getting hurt the most right now. It is down over 2% currently, and S&P 100 also heading lower at an intraday low right now. S&P 400 and Russell 2000 also continuing a declining trend that began in the afternoon on yesterday. TSX is lower on the day as well, down over 1.5%. The Treasury yields are lower right now, reading 3.126%. UP, big gap up, mostly consolidating since then, but also setting a new intraday high currently. Gold, GLD, is lower on the day. It is trending lower. It did spend the morning in positive territory, but it has declined and is now down 19 cents, 116.20. TLT, big gap up and currently consolidating sideways. And finally, USO is up right now 1.6%, reading at 14.27. And that's all I have for our final market update. I'm going to pass it back to you, Tom.
Okay, let's take a look at a couple of charts very quickly. First one being the S&P 500. This is an hourly chart. Showed this a little earlier, but we have broken down. Yesterday, we broke down the lows beneath that October 11th low. You can see the PPO is now back down below the center line, starting to point lower. Things could accelerate this afternoon if we fail to hold yesterday's lows. We had a nice rally yesterday, but we've given up back almost all of that on the S&P 500. You can see the overall trend remains lower. One of the areas really continuing to struggle, home construction. This is an ugly weekly chart. Talked to several times about waiting until we got that breakout above that 20-week moving average. That certainly was sage advice there, because the group continues to really accelerate to the downside. And I mentioned the new home sales report this morning, which was horrendous, way below expectations. So this is a group, again, that for now we just want to simply avoid.
All right.
And it is time. Under the radar. What are we going to come up with today under the radar? I just look under a bridge and just hide right now.
I know, seriously. There are a few bright spots out there, but not very many.
Yes, you're right. There are.
Yeah. I'll share what I have. and you can let me know what you think. But I went ahead and ran this particular scan. You know, I'll put this in the Market Watchers Live recap, but, you know, basically looking for a PMO that's rising, that actually is on a buy signal currently, so that I could get a little bit more protection there, as well as having the EMAs lined up in the most positive way possible. And so I did come up with a few here, and Boot Barn is the first one I'm going to show you. Granted, it is in a declining trend. But, you know, I think there's possibility here, mainly because I've got a PMO that is trying very hard to give me a buy signal. And currently it's not on one, but I suspect if we could just get above that declining tops trend line, we should see that buy signal. And, you know, so I think there's some possibility here. I do, the one caveat, of course, is we're in the consumer discretionary area, and I do think the market is, you know, softer, but I thought this one was interesting. I would keep this on the watch list and watch for a breakout from that declining tops trend line, and make sure that the PMO starts to really pick up to the upside. But that was one that I thought might be under the radar. This one I thought looked really nice. Church and Dwight Company, CHD. This one's got a nice little breakout going on today. It failed previously, but it is trying to make another move to the upside. We do have a PMO buy signal coming in right now off of this V bottom, which I think is positive. We have a good scooter. I'd like to see that breakout, but I think that it is certainly possible. So this is in that consumer staples area, which I feel a little bit more comfortable with, given the market right now, but we'll have to see if it can break out. Look at the PMO on the weekly chart as well. I thought that was nice, getting that bottom above the signal line at this point. So I think, you know, CHD, Church and Dwight looks good. I thought this one was interesting, mainly the name, International Flavors and Fragrances. I guess flavors are also specialty chemicals. I don't know. I thought that was interesting with that name. But anyway, I thought this one looked like it might be traveling a bit under the radar. I do have a PMO buy signal that just came in, but we are having a little bit of difficulty here at this area of overhead resistance, and it's not really a surprise. You can see it's pretty much lined up with these March, April tops. It is also lined up with short-term overhead resistance, but I would be watching this one closely because I did get that buy signal. It does have a good setup on the EMAs right now, so I would be looking for that upside breakout. So this one might be traveling under the radar for a little while longer, but I think it could be put in there. UGI Corp Holding Company. And this is in the utilities area, which I feel a little bit more comfortable with as well. Look at that PMO buy signal in the thumbnail. It's a lot clearer there. I think that's very positive. You can see that volume was picking up here on that move to the upside. So we got a higher top on the OBV, which I'd like to see. Higher bottoms on the OBV as well. Nice looking scooter still, I would say. We don't have an actual breakout today, and we did fail before. But again, this one might be interesting to watch for that breakout. And if you did want to get in a little bit early on this one, I think there's a lot of opportunity to set some stops here within this consolidation or trading range that we see here. And I'm going to finish off with Coca-Cola because it was my favorite of all of them. And here is why. First of all, I like the space that it is in right now, and the market is you know, isn't very healthy. The consumer staples area is great, and let's face it, everybody likes to have their Coke. So I know I do. I still have to have that. I almost consider that a regular thing. Need to have that on supply. So we do have the buy signal. We can see the scooter is now moved up into that hot zone, as I would call it. You can see OBV has also set up some new highs here as it's moving up. Some nice volume, I would say, on the move. We did get the breakout here, a short-term breakout, but we are looking at overhead resistance here at that January top. I still feel really good about Coke. I think we're going to get that breakout. We already got the breakout on the short-term basis. And that PMO, I mean, seriously, buy signal right above the zero line. I couldn't ask for much more there. So if you really do feel the need to get into the market, I think this is one of those spaces you could do that. So what do you think, Tom?
Well, I'm going to agree with you right off the bat. I'm going to start off with Coke. This is the first time, I think, that we have gone through one of these segments like this and actually had the same stock. But
yeah, because we do it independently, everybody. We don't have a big discussion, so it's always a surprise.
Yep, we normally don't know until literally we're preparing, last couple minutes for the show. But anyhow, Coca-Cola, we do have the breakout, big volume, but I am going to offer some caution. Number one, the market is beginning to sell off again here, and every stock is subject to a big sell-off. It doesn't really matter. Now, some of the staple stocks like Coke probably would go down less than some of the other areas of the market. That's why I think it is a little bit safer and why we're seeing money rotate into that area. But you can see we're already about 40 cents, almost 1% off of the earlier high. And if we come back down and we fail to get this breakout, we got to be careful. Now, I was looking at, and you mentioned, Erin, the weekly chart. And when I pulled that up, I did see this. This looks like a nice uptrend. Whoops, I don't know how I just got that. We did have a nice uptrend, though, on Coke. Here's the Coke chart. And I don't know if you can call this a cup because it comes down quite a bit. You shouldn't come down with a cup that's more than 50% of the uptrend. So that's kind of close. But still, you had an uptrend. We were weak for a while. We've come all the way back up, and you can see we have now tested that overhead area. This is an area where we might be ripe for a pullback. So if later today we fail on that daily chart, just keep in mind we also are at a major resistance area on the weekly chart. And so if the market starts to fail and Coke fails on the close, I think we could pull back. But I still like the stock overall, because if I pull up my relative chart, you'll see that Coke versus the soda index, as we're trying to make this breakout, look at where the soda index is, way off of the highs from back in January. So what that means is that Coke, you've got one of the leaders in the space, and it's also a very recognizable name. It's going to be a little bit of a safety hedge in the market. It's been outperforming the S&P 500. It's at a multi-month high, and sodas are beginning to pick up versus the S&P. So there's definitely a lot of positives here, but I don't want to suggest that you can't lose money in this stock, because again, if the market goes down, chances are we're going to see a bunch of other stocks going, a lot of stocks going with it. I do also want to mention Coke has a yield that's well over 3%. So it does kind of give you a little bit of protection there. If we were to fail, pull back even to this 44 and a half area, I think you do still have a yield, which should help soften the blow a little bit. Next up, Kroger. And I am going to give you several names here in the consumer staples area, because I believe that's probably the safest way to trade on the long side right now if you're going to. Kroger, gap down. It came back up. You can see the failures at the 20-day moving average. Yesterday, we climbed back above it. I would have liked to have seen more volume. And again, I'm going to have very tight stops. If I'm trading this as though we're getting a breakout above the 20-day, I don't want to see a close back below the 20-day. So we're talking about less than a 1% stop here for me on Kroger. I'm going to keep my stops very tight. But if it does manage to hold the 20-day, we could easily see a move back up to 30, which on this stock would be a pretty nice 5% or so gain from where it is currently. Also, Kroger has a 2% dividend yield. Conagra, here's a food products company. This one went back up above the 20, failed on pretty good volume, and then came right back above it. And you can see has been holding that 20-day moving average. It also is not far from breaking out, and its group is quite a ways away from breaking out. So we are beginning to see a little bit of relative strength, at least, versus its peers, and versus the S&P 500. And you can see the peers versus the S&P has been moving higher in October. Money, again, rotating towards defense, which I think is the way to play this market on the long side to help manage risk. And Conagra, I don't know if I mentioned, 2.35% dividend yield. Let's take a look at Colgate. Colgate, if you look at it, I'm going to pull up a one-year chart here. But Colgate, 2.64% yield. just recently pulled back not too far from its longer term support or intermediate term support around 61. It is getting back up above that 20-day. This is kind of similar to what we just looked at. I think it was with Kroger, or no, it wasn't Kroger. I think it was Conagra. We broke back up above the 20. We went back down, almost filled that gap, and now we're back above the 20. If I traded it, I would be treating this as a breakout above the 20, and I would keep a tight stop beneath it. STZ, which is Constellation Brands. This is a distiller and vintner. Nice move up. Here's a gap up. Once again, we've had weakness the last 5 days, but we're getting close to filling this gap after a huge volume gap up. This is where I would look for a return back to the upside. If we moved below 210, I'd get out. Stock's at 213. Again, pretty tight stop on a very conservative trade. TAP, which is Molson Coors Brewing. I'm going to bring up a longer term chart. So let's take a look at a weekly. I'm going to stretch it out for you, maybe 7 years. We're at a major support level right here. And you can see that's a nice reversing candle currently with a much higher PPO. Positive divergence, reversing candle. And if you go back, this 60 area has been a big, big support area on Molson Coors. So I could take a position here if I wanted to be, at least have something in the market. It's defensive. It is showing a reversal. It is at major support. I could even give this one maybe 4% to the downside, looking maybe for a move back up to that 50-week moving average near 70. I think your reward to risk is pretty solid here. Again, no guarantees. And then the last one I want to mention, this was outside. This is in the consumer discretionary space, so it's more aggressive. But if we pull up a longer-term chart here, I think what you're going to see is a really solid breakout on Alta above 260. And if we pull back down into this area, 260, 265, I think the reward to risk on this stock, even though it is in the more aggressive consumer discretionary area, I think that reward to risk would be pretty solid. So let's summarize the stocks that we just covered in the under the radar session. And then once we take a quick little look at that, why don't we take a brief look at our poll?
Indeed.
Because I don't know how you're feeling about this market, and I guess, we talked a little bit about this earlier. I guess you have to define what you mean by short term. But you can see the majority of our poll respondents are very bearish here in the near term. What are you?
I was bearish as well. I think what Roman wanted, and I said in the chat room about this poll, is that short term does mean different things to different people. So he was curious what you thought using your short term the way it is. So for me, short term is days to weeks, and I would say I'm bearish there.
Yeah, my short term is more intraday to maybe up to a week, and I'm definitely bearish. I mean, that could change literally this afternoon. We could go down 500 points and then have a huge reversal in the last half hour, and I could turn much more bullish. And it depends on where that money goes. If we got the big reversal, I mentioned earlier in the show that the problem I'm having is that the moves that we're seeing back to the upside in the market are actually seeing money rotate into defensive areas. Defense, it's not a risk on mentality when we go back up, and that's not good. So I am not at all surprised that we have rolled back over today. I think it could be a rough afternoon and maybe a rough rest of the week. I said earlier, I'm in cash. I'm staying there for now. I'm just kind of watching the market. I don't need to be a hero. I just want to protect my capital. So that's where I am, but I'm definitely short, or bearish, I should say, here in the short term.
All right. Well, you're my hero.
Say what?
You're my hero. You don't want to be a hero, but I'm sorry, you're my hero.
Oh, that was so sweet. To close out the show too. Wow.
Exactly.
All right. Well, you're my hero too. There you go. There's your upcoming schedule for the next several days. I do want to thank everybody for stopping by. Roman was awesome today. Definitely a special shout out for his presentation. Hope everybody enjoyed that. Please remember to complete the survey as you exit. We do love to get your feedback and hear what you think of Market Watchers Live. Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great Wednesday afternoon, everybody. Be careful out there. We'll see you tomorrow. Happy trading.